In today's video, we're talking about RMD ages. That's the required minimum distribution, where the IRS makes you take money from your traditional IRA or your traditional TSP account. They've changed some of the rules, specifically the ages at which you're required to start taking that distribution. So that's what we're going to be going over next. Hey, this is Mel Stubbs. I'm a financial planner at Christy Capital Management, where we're helping federal employees plan for their retirement. If you need help, go to christycapital.com and click Talk to an Advisor. Today we're talking about required minimum distributions and the changes that have happened over the last year or so. So back in the day, the RMD age used to be 70 and a half. And as you can see here, if you were born prior to July 1st, 1949, that would have been your RMD age. Now, under the Secure Act, the RMD age changed to age 72. So if your birth date is July 1st, 1949 to 1950, those 18 months or so, your RMD age will be 72. Under the new Secure Act 2.0 that was passed in December 2022, they've increased the RMD age to 73. And you can see here that from 1951 to 1959, that's when you were born, that's your RMD age, age 73. Then for those of you that are born in 1960 or later, the Secure Act 2.0 pushes the age of RMDs to 75. Now you may ask, why do I have to do this? Well, it's a way for the IRS to ensure that retirees can't defer their gains forever. They require that you take a minimum amount out, and therefore you're required to pay taxes on it. The penalty for not withdrawing your RMD by the deadline, it used to be a 50% penalty. Now it's down to 25%, and in some cases only 10% if you can correct the problem within 2 years. They also are changing the rule beginning in 2024 where you won't have to take an RMD from Roth 401ks or Roth TSPs. This will make it a lot more like Roth IRAs, which do not require an RMD at all. So does this give you any planning opportunities based on these changes? I say it does. If you've got a rather large TSP account and you allow it to continue to grow all the way up to age 75, the balance can get really large by that time. And when they make you take out an RMD, it can be a pretty large amount, and so therefore push you into a tax bracket that you may not want to be in. So once you hit age 73 or age 75, you're required to take it out, and now you've lost control of tax planning. Based on your other income and whatever the tax brackets look like at that time, RMDs can push you into a tax bracket that you wouldn't ordinarily be in and you don't want to be in. So what can you do about it now before age 73 or age 75 is to do some Roth planning, to do some tax planning, to shift some traditional money to Roth with a goal of arriving at age 73 or 75 with a certain amount of traditional money, but not a huge amount of traditional money. Most people have the feeling that the goal is to have as much money as you can have, and the more money is usually better. But that's a great goal with the caveat of you want to hold your money in the best account. If you're holding it in a Roth account, it's no longer subject to taxation as long as you play by the two rules of no withdrawals of your gains until over the age of 59 and a half, and you've had a Roth IRA for 5 years. Growing a traditional account can definitely generate a problem when you show up at your RMD age and they make you take out a bunch of money. Once you start taking your RMDs, it's in the ballpark of taking around 4% out of your traditional balances each year. At that rate, for every $1 million you have, that can be about $40,000 a year that they require for you to take out. So maybe you have $500,000 or $600,000 now at age 59, but at age 75, you may have $2 or $3 million depending on how much you spend and how aggressively you're investing. Putting a bridle on the traditional money by shifting the money to Roth can be wise planning for some people. Now, make sure you're consulting someone one-on-one with your personal situation, but generally speaking, having more money in Roth as opposed to more money in traditional can make a lot of sense once you hit your RMD age. The fact that these ages have been pushed out, it gives you more time to do the Roth conversions. One of the planning ideas that we go over with clients is figuring out how much you can Roth convert each year so that you show up at your RMD age with an appropriate amount of traditional money. For some people, that may be having zero in the traditional account. For others that are charitably minded, you may want to have some traditional money left over so that you can take advantage of the qualified charitable distributions and get an extra tax break when you hit age 70 and a half. But that's a discussion for another video. If this tax planning is foreign to you and you don't really understand what we're talking about, reach out to us at christycapital.com. If you want to check out one of our other videos, here's one about the secrets to reducing taxes in retirement. If you have a large TSP that's traditional, you'll likely have a tax problem in the future. Check out this video for more ideas. My name is Mel Stubbs. See you on the next video.